Brooke Dane is co-portfolio manager of the Technology Opportunities Fund at Goldman Sachs, which is up 45% in 2020. He sees the tech pullback as a buying opportunity. Brooke, welcome. I suppose you don't think that rising rates are a problem, although we have seen rates steadily rise since the beginning of this year, and we've seen all of those big cap tech stocks that I named in the intro, while they're off just single-digit percentages this week, they are down double-digit percentages from their highs this year. So how do you interpret just the price action? The price action is telling us that it is a problem for technology to have rates go higher.
Yeah, thanks, Melissa, and great to be on the show. So, our central belief is that, we're at the front end of this massive wave of tech innovation, and that we think that there's incredible opportunities in the sector. And while rates have moved up, and, that does impact long-term values of the stocks, what we're seeing is that these stocks have actually discounted much more of a rising rate than we've seen and we're likely to see. What we've been talking to our clients about is a couple key things. So first of all, we think that there's a huge opportunity in that next level down of companies below the mega cap names, both in the US and more importantly, globally in the tech sector, where you can get real opportunities to own the next generation platform companies that are rising. Secondly, we really think that you want to be balanced. You want to have a portfolio that's built with some of the big disruptive, fast-growing, companies that are changing the world, but you also want to have some of the more compounding companies in there that are steady growers and that are, compounding at high rates of return. So, we're always talking balance. We're always talking about moving incrementally into these things. But as we sit here, right now, with the pullback we've had over the last week, we think there's real opportunities to put capital to work in some of these high growth names specifically and some other areas as well.
So the high growth names that are sort of the next level down, not the biggest of the big cap technology stocks, Brooke, how should we think about them in terms of valuation? Because what seems to be emerging in the tech space, at least amidst this rising rate environment, is a bifurcation in terms of the highest valuation stocks, which are hit much harder, versus the lower valuation, quote unquote, value technology stocks, which have weathered it a lot better. And I'm thinking in terms of high valuation, the IGV software ETF, for instance, got hit much harder this week than the overall NASDAQ.
Yeah, so, software is one of the real innovation engines out there in the global economy. And we are seeing a whole new generation of companies come up that we think can be very large companies over time. We do think this is a huge role for active stock pickers to come in and differentiate between, what are the likely champions over the coming decade versus what are going to be on the wrong side of that disruption. But with that said, you've seen kind of average price to sales multiples come in by 3 or 4 turns across the growth software universe. And while price to sales is only kind of one metric of valuation, it's a decent shorthand thing for looking at, what's the market pricing these things at. We think there's a lot of these companies that can grow, sustainably in the high 20s for many years to come. And that at these kind of price levels, it's starting to get in the zone where we're interested in adding to positions. So, we basically have a shopping list of some of these things that we think are the secular winners that we've been looking for opportunities to add to. And, the pullbacks like this create opportunities for that.
When we do see a sell-off, though, in response to higher rates, Brooke, is that your cue that overall you should be looking for opportunities to trim back on positions in perhaps some more highly valued areas, or maybe even the big cap tech stocks, because you said you're moving away from them?
Yeah. So, what I would say is that we're guided by the fundamentals of the companies. We spend a lot of time doing our own research and figuring out how we think these businesses are likely to evolve over the coming years. And so when we see a pullback like we've seen this week, but the fundamentals of the companies remain strong and remain positive and are inflecting in the right directions, we tend to use that as opportunities to add to positions, not to pare them back, because we do think ultimately the fundamentals of the companies win and will decide what's happening in the marketplace. So, just to keep talking about software for a minute, you've seen much better performance on the fundamentals, whether that be lower churn rates, whether that be higher net dollar retention rates and pipelines building strongly. We see real opportunity for these companies over the coming year, a lot of them to buy and add to positions. So.
All right. Brooke, we're going to leave it there. Thanks so much for your thoughts.
Shepard Smith here. Thanks for watching CNBC on YouTube.